Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Trishul and Aaron discuss the value of financial planning beyond just investments, such as taxes saved, utilizing retirement plans, and insurance analysis. They go over the pros and cons of working with an advisor who also sells the recommended insurance and investment products. This brings up the history of financial advice and the difference between fee-only, fee-based, and commission-only. No compensation structure is free of conflict or misaligned incentives. Even so, understanding the nuances involved can help you find an advisor that will put your interests first. And now, on to our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So last week we talked about looking at studies of kind of the value of a financial advisor and kind of where we could get good quantitative research and kind of some of the problems with that methodology. But there's been pretty good research on identifying some of the specific components that make up the value of a financial advisor. But because both the firm that did the study and just the history of the financial services industry, it was inherently related to kind of benefits related to like an asset under management scale, that if an advisor charges 1%, a 1% fee on asset under management, does the value outpace that? And Vanguard did go say like quantifying, yes, if you incorporate things like automatic rebalancing, asset allocation, tax loss harvesting, there's kind of enough advisor alpha to make up for that. But towards the end, we kind of talk about that while the value related to investment advice from a financial advisor probably does make up for their fees on the investments specifically, and like that's what the study's measuring, most clients don't necessarily think in terms of their financial advisor in terms of the basis point value that they're getting. And this is both backed by kind of client surveys, but also in our anecdotal experience of working with our clients, that most of the kind of good feelings that lead to those really high retention rates come from financial planning components, not the investment advice side. And so we addressed a few, but today we won't go a little deeper on this. So just kind of thinking about if a financial advisor can kind of make up for that advisor's fees through advisor alpha, what are some of the benefits and the value on the financial planning side? So one example I think about that I've actually shown clients, because I work with clients with stock options and especially with incentive stock options, I can actually show them kind of a calculation. If we follow a good ISO exercise and sales strategy that takes advantage of the benefits of long-term capital gains, but follows all of the rules, being aware of potential AMT credits, and kind of investment risk related to holding on stock longer than you need to, I can show you, here's what your tax bill would be like over the next 3 to 5 years if we have an ideal ISO exercise and sales strategy. On the other end of the spectrum is if the stock is liquid or the options are liquid, we're out of an IPO, we're out of a 6-month period, and everything's vested, you could exercise and sell everything right away and you remove all the investment risk, but your tax bill is so much higher. And I can kind of show them the difference between these two strategies sometimes can be a 6-digit tax bill. And so a good strategy that balances investment risk, the lifestyle goals, what they need the money for, what they would hope to use the money for, find some place in the middle where I can actually show them, yes, I can help you save tens, if not hundreds of thousands of dollars in taxes by implementing this strategy well, understanding the investment risk you're taking on. And that has nothing to do with investment advice, even though it's technically stock. It's all the taxes and the financial planning side. And this is just one example where the value I provide to clients doesn't have to do with the investments that I may or may not be managing down the road. And I think that's what I want to kind of get to is separating out kind of the value of financial planning or a financial planner from our conversation last week that really was investment centric. So Trishul, for you, if you were thinking of a benefit or value you've provided to clients that was not necessarily investment related, but was truly financial planning related and truly valuable to them, what's one of your good examples?
Yeah, I like the one you just mentioned about the ISOs and company stock and options in general that you might get from an employer, because it's one of those areas where you have a decision to make. And based upon this decision, it can have a pretty big difference in the outcome as far as, in this case, taxes. And often a lot of the things that we do talk about do come back to this notion of taxes and understanding how it plays into the big picture, having a sensible tax strategy. And of course, one thing we've mentioned in the past, for example, is if you're saving for retirement and you're putting money to work for the long term, it's always good to put that money to work in a shelter, meaning the various tax shelters that the government provides that allow you to defer taxes or stave off taxes or grow things in a tax efficient manner. And the common ones are the IRAs, the traditional and the Roth, and your employer may have like a 401k plan or something like that. And we showed, for example, in one of our earlier conversations, that if you're not doing that and you're putting money in a taxable account, well, just by making that one shift, you're taking the same money has the same earmark in terms of its end goal, your retirement, but just putting it in a different bucket, like a IRA, and you're maxing that out every year. Well, just doing that alone, something that we mentioned, $6,000 per year, husband and wife, $12,000 per year over 30 years. Just doing that alone, you have about $1 million by the end of that time period, assuming like a 7% return or something. Now, just kind of taking that to the next level, there are cases where you have a situation where you have a family business, and here the great part is you have a little bit more flexibility to take advantage of some of these employer-sponsored plans because you're the employer. You get to craft your own plan. And that's an area where, for example, I've helped clients to set up plans that are quite favorable to their key employees, mainly themselves. So something you can do, for example, is create a solo 401k plan, a 401k plan for just yourself and your spouse, for example. And there you can set up the rules to be quite favorable to allow you to kind of maximize the amount that you can contribute. Now, typically with an employer plan, if you're at a standard company, you might put in your employee contribution of like 19.5 thousand, and then your employer might match a few percent. So you might get like 20,000. But it turns out that the cap is far higher if the employer wants to put in more on your behalf. And when you're the employer and the employee, well, then you're doubly incentivized to take advantage of things like this. And so in this case, you could actually cap out at, this year, 58,000 per employee, your husband and wife. So now instead of putting in, close to 12,000 in your IRA, on top of that, your husband and wife can put an additional 116,000. So, just by doing this alone, instead of ending up with $1 million, you'll end up with $10 million because you're putting 10 times the amount in this tax sheltered account. And, if you do just this and nothing else from your business, I think you're going to have a pretty happy retirement with, just this small change, rather than, just putting that same amount in a taxable account year after year. So it's just, again, one of the things where if you have the opportunity to make these types of decisions working with a planner, then you can kind of dig into the weeds and set up a vehicle like this for you, in this case, your small business, to accelerate your growth over time.
So I like that kind of phrasing of, if you're able to save that much money, okay, your income's kind of high enough, you're able to save that much money, that's what you're going to save. Without any kind of advice, you could do the IRA and the rest would go in a taxable investment account. The amount of money going in is the same. We're going to say it's just going to be an S&P 500 ETF or a target date index fund, so that the investment is the same. But by taking advantage of your financial planning advice and using the correct retirement plan that fits their lifestyle best, they would, because I think that's a comparison, is it's not comparing $6,000, or in the case $12,000 in an IRA versus 16,000, you said 116,000 in a solo 401k, because if you could save 116,000, you could save 116,000 outside of in a taxable investment account. So it'd be not comparing 1 million, 10 million, but in this case, and correct me if I'm wrong, you would be able to put in that $116,000 pre-tax. So you get a tax deduction on that amount. So if you're making enough money to be able to save that level, your tax bracket's probably going to be pretty high. So getting that huge deduction on the money going in will really help. And so the compounding benefits of, one, you probably have more money saved, because if you could save 116, but that's 116 pre-tax, you might be comparing that to saving something like 70,000 per year, maybe 70 to 80,000 per year, because that would be an after-tax amount. Then that 116 is growing tax deferred, whereas the 70 to 80K would be growing in a taxable account. So even after accounting for the investment growth, our growth in our taxable account won't be quite the same. And then maybe kind of control the money coming out will still be at a marginal tax rate, but if your income's lower, you're comparing kind of a lower marginal tax bracket to long-term capital gains. But yes, I think that there's pretty good studies that anytime you can use tax deferred accounts and you get a tax deduction and you can kind of control your tax rates and money going in versus money out, you're probably still going to make out on the scale of a compounding like 1 to 5% per year. So it might be comparing like $10 million, or it might be like $8 million after tax to $6 million after tax if you weren't using an employer-sponsored retirement plan.
Right. Yeah. There's lots of assumptions, and we've talked about some high-level numbers on how that might work out. But at the end of the day, it can be pretty substantial, because you add up, a percent, even a percent a year over 30 years. That's pretty significant.
Yeah. So, but that's a great idea. It's like same amount of money, same investment, by implementing just a financial planning strategy, the benefits compound exponentially. And again, like you said, it could be on the scale. And your example would not surprise us, on the scale of $1 million or more. That's a realistic possibility, and your fees over their lifetime are not $1 million.
Right.
So that's a great example. I like that. Any other things that you kind of think about when you were working with clients for financial planning? Because you mentioned the group, or the employer's plans. I had something else I was thinking, but I want to give you a chance. Anything else that you were thinking of there?
Well, of course, if an employer has a plan and you're not the employer, you want to take advantage of whatever they offer. And, sometimes there are things that they offer that you may not know about. Frankly, the employer themselves may not know about. For example, if they allow something like a voluntary after-tax contribution. and in-service distributions. You kind of combine some of these terms together and you get, some magic known as the mega backdoor Roth. And that might be an opportunity to also kind of accelerate the amount you might contribute to your employer's plan if that specific plan allows it. And again, then you might be able to cap out that instead of that 19,500 plus that few percent match, you may be able to voluntarily add an extra X amount to bring you all the way up to 58,000. So again, it's something you have to do some snipping around. And sometimes, frankly, the employer or the HR department may not even know the fine details of this type of stuff. And you may need to go to this plan sponsor directly and just kind of check. And if it turns out that the stars align, it's something that, again, if you take advantage of something like this, you might be far better off than if you didn't.
So, I want to double check. I believe it's the 401k summary plan description. Is that the technical document? Does that phrase sound right?
Yeah, the plan documents.
Yeah, so that the 401k summary plan description, any employee can ask for it, and you can get a copy either from HR from the plan sponsor. That would have all the details of if you could do a mega backdoor Roth. But again, it's kind of the company and the company plan have to allow it. But yeah, that's another great example. When I think of other financial planning benefits, one of the ones that comes up pretty often is looking at group insurance that's available. Not just group health insurance, because that's usually the default for the vast majority of employees in the United States, but looking at group term life insurance. And here, the key is, given your income, lifestyle, dependence, household situation, we can kind of calculate, here's how much life insurance you should have so that if something happens to you, your surviving spouse and dependents can still live the lifestyle they want. Part of that conversation might be, would the surviving spouse continue to work? Because that implies you don't need as much insurance. Or do you want to provide enough life insurance that if something happened to you, the surviving spouse would not need to work? That's a good financial planning question that I help clients answer. I do the math for them as well. But once we kind of have that conversation, what do you want to provide if something happens to you? And say, okay, we need to have $2 million in life insurance for the next 20 to 30 years, usually depending on ages of kids, age of the couple, when they might be financially independent. But a lot of times, if they're late 20s, early 30s, a 30-year term, like kind of length of that policy would be a good time frame. But they also have group life insurance available to them. And so the more difficult part of the conversation is, should they go with, if they, let's say they have $1 million available through work. There's they make $200,000 and it's a 5 times salaries, and they have $1 million group term life insurance through work. Almost always a group life insurance policy is more cost effective than a personally owned policy. I don't know that I've seen any situation where that wasn't the case, because you get into law of large numbers aspects, you get into group and class, and just like how the ratings works for the company. And there's a little bit of employer subsidization in there sometimes, but it's pretty consistent that group term policies are cheaper than going out and buying your own insurance policy. So you need $2 million in life insurance. Do you get a $2 million 30-year term that you own? You can go through different insurance underwriters, different insurance brokers, kind of shop around for the best rate, best underwriting, best kind of payout situations. There's a few other aspects, but you need $2 million, or do you do $1 million of your own policy and $1 million of a group policy? Because the conversation isn't just, oh, I need $2 million and let's go with what's cheapest. But if you say, for example, go with $1 million of your own policy and $1 million of a group plan, that's probably cheaper now. But if you happen to change employers and your next employer doesn't offer group insurance, then it's a conversation of, okay, how do we get that next $1 million of coverage? Because as you get older, one, the possibility of a health event increases. So it's possible that your rating that you would qualify for is just less likely. Two, just as your age increases, so that's going to increase the cost as well. That's just kind of the way life insurance prices out. The older you are, the more expensive it is. But it's that kind of usually that combination of life insurance, especially on a per $1,000, and that kind of that whatever the rating is going to be more expensive as you get older. It's possible if a life insurance of a health event makes it more expensive. You might have gone from a preferred rating to a standard rating. But on the flip side, you'll have saved up more over that time frame. So maybe what that $2 million you needed at age 30 might only be $1.5 million at age 35 or 37. That's a possibility, and we can kind of do that math. And so the financial planning conversation is usually related to that of what is the likelihood that you'll be at this employer longer term? Do you really like the work, or can you see an event that you might move on not that long down the road? You might see something like, well, I think I might stay here and through my stock options vesting, but then I want to go back to work for a startup. And that just in my industry and kind of being in the Bay Area, that's a very common example of they have the equity, they kind of vest, and then they go to work for the startup. The startup just may not have the benefits. The smaller, younger companies are just less likely to have those types of group benefits. And this is the conversation I'll have with clients often, is trying to figure out, okay, we know you need $2 million of life insurance. What's the best way? Because it's not a clear-cut answer. It's not going with the cheapest per se. Sometimes they will go with the personally owned policy. Maybe they might do group insurance on top of that sometimes, but it's not necessary. They might be overinsured at that point, but they're doing it for their lifestyle flexibility over just pure cost savings. So that's another example of kind of the value that I try to provide to clients on the financial planning side that has nothing to do with investments. Another component of that is because I've made a commitment to be a fee-only financial advisor or a fee-only financial planner, I don't charge a commission. I don't get compensated for selling insurance. And so my clients know that when I'm saying, yes, you need $2 million in life insurance, it's not because I'm trying to sell them $2 million in life insurance. It really is in their best interest. It's the kind of the financial planning recommendation, not necessarily the insurance recommendation. So kind of, does that make sense? Kind of that distinction, Trishul? Like because I'm fee only, it truly is a financial planning recommendation, not like another compensate. Like I don't want to say I'm removing conflict of interest, because I think that people who sell insurance do provide a good value, but there is that incentive. I guess I say there would be that incentive to push that personally owned policy, even if they did have the group term, where I tend to be a little more agnostic.
Yeah, that's a good point. I think it highlights the notion that there's many different flavors of advice that you might run into in the financial services industry. And it's probably important to just understand the distinctions that are out there. What flavors are out there, and what might make sense for one situation may not make sense for another situation. For example, if you're pretty clear in what you already want and you have a pretty well-defined goal, I want a 15-year term. I want it, with these parameters. I know what I want. Basically, what that means is you want a product. You know what you want. You can go out and get that product, right? You can price it out, get a few competitive quotes, and you can select it. And at that point, the decision is a little well defined, and going to an insurance agent is okay because you're just getting information about the price of a product. However, it's a little bit different story if you don't know which product you want, or if you even need a product, in which case you probably want a different type of advice. And that's where, this more planning type of advice may come into play, because it, just kind of behooves an individual to understand that these are just two separate buckets to think about. Another thing I'd like to kind of mention is, let's say you go to a doctor's office, and there's two doctors that you can see. One doctor is saying, you need pill X, and the other doctor is saying you need pill Y. But, by the way, the first doctor gets paid, 10% from the pharmaceutical company for every pill X he sells. That now, it could be true that X is best for you, but, there's that underlying notion that maybe incentives aren't fully aligned. And when it comes to, seeking planning type of advice, not product type of advice, it might make sense to seek out advice that has that kind of conflict of interest as less of an issue as you might get with a fee-only planner like yourself or myself. So, just to put some terminology out there, because if you're in this space, or you may know, the nuances, but if you're not, it gets a little murky. The traditional model for selling financial products has been a commission-based model. And that's true for insurance type of products and also brokerage types of products, where, for example, if you call up a broker and you say you want to get into the market, and can you give a recommendation? Well, the broker will likely give you a suite of products that make sense for you. However, those products will likely be tied to a commission, or it's likely that those products have a commission because that's how the broker gets paid in this traditional model, this commission-based model. And yep.
Okay, go ahead and finish. I think we might have to go back a little bit in terms of history, but go ahead and finish this up.
Yes, there is certainly a history here to all of this, but just kind of how this has kind of changed in terms of different flavors. There are other ways of getting advice, and the way that Aaron and the way I operate my business, and Aaron, you do, it's through something known as a registered investment advisor. So this is a business that's designed to provide advice, and you need a certain set of registration with the state or the SEC, depending on your size. And depending on that, what might happen is you would get advice based upon the qualifications of this individual. Now, it's true that you could be a fee-only advisor as an RIA, but you can also be a fee-based advisor as an RIA, or you can also just accept commission. So that these are three different terms, and it's important to understand the distinction. So fee-only means you won't accept commissions under any case, and this is essentially based upon how an individual RIA decides to set up their business. It's maybe it's becoming more common these days to be fee only, but the notion is, we want to separate the commissions or the products from the advice.
Okay, yep. I think that we need to kind of give a little more context. So I think this is actually really important, going back to the beginning of the conversation, or even last week, of the financial advisor versus the financial planner. And maybe we'll get into the title a little bit, but or like who's providing advice. So because this also is very related to that idea of the commission. so going back to the 1930s, the Securities Act and I think the 1933 Securities Exchange Act 34, they created the environment where there's certain disclosures, and so someone's selling you a stock, the company had to be real. So basically, there's too much fraud, and so, but it was still they're selling stock. That's the classic stock broker. You are looking to buy a stock, you call them up, they'll sell you a stock, and they collect a commission on that. You're looking to buy insurance, you call up the insurance agent, they collect a commission. There's also state insurance agencies that regulate those. Whereas the Investment Advisors Act of 1940 is what created the registered investment advisors that allowed financial advisors to charge fees for advice. And this has been a kind of back and forth. It's like inside baseball of the financial services industry of brokers can kind of provide advice that is incidental to the sale of the product that they're trying to sell. And the kind of classic example is if you need insurance and you don't know how much, an insurance agent calculating how much insurance you need is kind of providing advice, but that's considered incidental to the sale of the insurance. When that makes sense, like if you need $200,000 versus $2 million of insurance, yeah, it makes sense that they need to actually figure this out, ask some questions about your income, ask about your lifestyle, what you're trying to protect, what's your age, how many dependents you have. So like that makes sense. But if they're holding themselves out as a financial advisor and getting paid for the advice they're giving, then they're supposed to be registered with the SEC or state securities as a registered investment advisor. Sorry, like the individual is an IAR, investment advisor representative of a registered investment advisor, RIA. And so this is kind of now the weird environment that we're in, where you can actually have people who are dual licensed and are able to both sell the stocks or insurance, and by selling stocks, it kind of progressed to selling mutual funds, and you collect a commission on the mutual fund. Variable annuities are a combination of insurance and investments that also provide a commission. So we're kind of lumping all of those things in together of like selling the investment product. While the 80s and 90s were coming to be an actual stock, the laws apply more or less the same today now. If you're selling a mutual fund, stock, and you're collecting a commission on. But it's easy for there to be confusion, in part because financial advisor is not a regulated term. While the Investment Advisors Act does use that phrase, financial advisor is not a requirement. So you could have someone who is only insurance licensed putting financial advisor on their business card. You could have technically even a mortgage broker putting financial advisor on their business card. But for most people, they see financial advisor, they don't know the difference between a fee only versus fee based. Where now, if it's fee based, while it might be that most of the revenue does come from those fees on assets under management, that's just a more classic financial advisor. If they are also insurance licensed, they can also collect the commission on that term life insurance policy that they're recommending. So they might do the financial planning work, help you calculate it. Here's how much you need. They look at the group benefits, and you know you need that $2 million life insurance policy. So it gets really hard to distinguish between financial advice, especially kind of financial advice that's not directly on investments, and financial planning, because a lot of these things kind of get mixed in together.
Yeah, I can understand how these different puzzle pieces do eventually maybe fit together, but there's a good amount of overlap as well. And it's kind of like a messy Venn diagram of many different circles, more like a puzzle that makes a picture. And it does get tricky because, fee based and fee only, those sound very similar, but that they could mean, depending on the situation, two quite different things. And the other thing, that kind of implies is you could have an RIA that's dually registered as a broker dealer, which means that they're giving advice and selling products at the same time. Now, something that comes along with an RIA is something known as a fiduciary relationship. So, what that means is, as a fiduciary, the requirement is it's known as pretty much the highest standard of advice that you can get, where, as myself being a fiduciary, I'm required to put the best interests of my clients ahead of my own. And what it really means, what that kind of says, when I think about a situation, I have to really think, is this really in the best interest of a client, or is there some sort of conflict of interest involved in what I'm doing, in which case I have to overcome that before I provide the advice. And if you're an RIA, you have this responsibility, but if you're duly registered and you're also selling products, well, then it becomes a little bit murky. And that's why, if you're an RIA and you're fee only, meaning you're an RIA, you have this fiduciary responsibility, and you're fee only, meaning you're not collecting commissions, you might be in a better state to make these types of decisions a little bit more easily or less conflict prone in terms of providing clients with the best advice possible. I think that the third distinction, perhaps with a business like mine and yours as well, Aaron, is that we're independent, meaning we're not tied back to a larger firm that's, that has different, obviously not product goals, but, maybe sales goals or revenue goals or whatever type of goals. We're our own decision makers in this. And the notion of being independent might also be a helpful thing to understand or distinction to make, where if you're seeking advice, in many situations, having that advice come directly from the person making it without having strings attached to that person giving advice might be helpful to understand as well.
Yeah, that's I do like the fiduciary standard, putting clients' best interest first. But you start to, like, even within that, like what I think of that's kind of clear cut, there's still kind of gray areas that unfortunately play out in reality. For example, if a client paid a one-time fee for a financial plan, you put together a really good analysis, you did all the work of, like, here's how much you need to save, here's how much you need insurance, you need these two types of insurance, you need to save this much in this retirement account, you need to set up this retirement plan. And if you do all of this and you stay consistent for the next several years, then you will achieve all the financial goals you said you wanted to achieve. Like, you can put together that plan. So you give them that, they pay you the one-time fee, and a year goes by and they haven't done anything. Have you really put their best interest at heart? Have you actually helped them? And so sometimes that's why, like, I don't behoove people who are fee-based, because it's sometimes it's okay to have that incentive to make sure it gets done. You need to actually have someone who's going to help you open up those accounts and get the money invested and establish the systematic savings and establish the systematic investments and make sure that you do get the insurance in place. And so that's why I say it's just being fee-based and accepting commissions does not mean you're violating a fiduciary standard. If it really is in the client's best interest, then yes, being able to provide all of those things in one place can be a very valuable service. On the flip side, there are those who are fee only, who even if they're putting the client's best interest and they only charge fees, it can still be a gray, murky area. If you have an old 401k through an old employer, do you leave the money in that old 401k? Do you roll it into your current 401k? Or do you roll it into a traditional IRA that the advisor can manage for you? Now, the classic response about being an AUM advisor is that they're incentivized to help grow your assets, which works out really well. If they're pushing you to save more and invest appropriately to grow your assets, that's going to help you. And that's a good kind of reason of why they are tying fees to AUMs, that they want you to grow your assets to make sure that you're growing your net worth. It might provide so much more flexibility, so more other intangible benefits to having a larger asset base. But if that old 401k, maybe it makes sense to leave it there. Maybe it makes sense to roll it into your current one, because you might be able to kind of go back to the retirement account and all the financial planning related. You can do Roth conversions more effectively if you have little money in pre-tax traditional IRAs. That because there's a pro rata rule that if you do Roth conversion, it's supposed to account for all of your IRAs. So it could make sense to have money in 401ks, which are not included in that calculation, and do Roth conversions with kind of all of the pre-tax IRA dollars. That's an example of there could be a reason that would not make sense to roll 401k dollars to a traditional IRA. But at the same time, sometimes 401ks have higher fees than traditional IRAs. And at the very least, they're really hard to see and hard to find. Sometimes they argue for lower fees, but my guess is that 401k fees are probably higher than fees in an ETF program, but maybe not including the advisor fee. So it's like that's a hard conversation of just being fee only also does not kind of absolve the advisor of all of the kind of murkiness and gray areas.
Yeah, I agree with that as well. It's also something that the industry does try to regulate. For example, having an RIA on its own also comes with a host of compliance related concerns. And part of it is, for example, we're required to, not trade ahead of the clients and record our transactions in terms of our personal securities accounts. And we're also required to disclose all these different types of conflicts of interest that might potentially arise with the relationship with a client, so that the client is aware that, some things like this might come up. And we have to, think through these types of scenarios and disclose them. And, hopefully that is comprehensive enough, but there's enough areas where it's hard to effectively police everything. It's just, a point where you can only add so much overhead and bureaucratic steps to the process, to the point where you still need to allow effective decisions to happen. And, I think what this also might come down to then is, just the relationship or the fit, for that matter, that you might find with working with an individual. Meaning, I think part of the story might actually be, how well do you resonate with the individual you're seeking advice from? How well, does that individual's background align with your values and things like that? The little more fuzzy types of decisions you may need to make when you're seeking out advice.
Yeah, I also think about that independence part of it too. Like going back, um, the last couple months, I've been having more conversations with clients that I use. I've mentioned in the past, I use SEI to help manage investments, especially either their ETF program or their direct indexing. I think that they do a pretty good job of keeping overall investment fees pretty low. They do a great job with rebalancing and the best job of any company I've seen on the tax loss harvesting side. I've genuinely been impressed, and I've been kind of trying to compare this to other companies for over a decade now, and they continue to do an amazing job at tax management and tax loss harvesting. So I'm very confident that having my clients, especially it's like stock proceeds that's sitting in cash, it's not another alternative investment. Okay, we want to invest this for your goals. Use an ETF program, low fees, tax loss harvesting. It's a taxable investment account. I'm recommending SEI because I think they genuinely do a better job than anyone else. But just because I can kind of list these things off, there's still hesitancy from clients, and there's always good questions. I'm really happy the clients are asking these questions, but kind of things like, why are you choosing SEI? And part of that for me is that independence of, because I think they're the best. I'm not actually paid by SEI at all. I don't have to recommend SEI, and we're not using, as much as I can avoid it now, the SEI mutual funds. That's how they used to be. They've done a pretty good job of kind of creating creating a platform to allow for ETF trading and other managed accounts. Used to be they're all the proprietary mutual funds, but that same kind of thing with Fidelity and Schwab, where if there is not that independence, are they recommending their own company's products? So now I feel confident that the fee only, and because I actually charge based on income net worth, I'm even agnostic to assets under management, and that independence allows me to be as confident as I can to providing conflict-free advice, but that there's still, because I charge on net worth, there's still that incentive to help clients grow net worth when it may be a point where they know they actually don't want to grow their net worth anymore. They want to be financially independent. They want to start living off that. And so we're no longer in a net worth growth phase of their life. And so kind of no matter which investment structure, or sorry, fee structure the advisor has, I think you're right about, think about that fit. Think about, do you like them? Can you start to develop trust in them? Understand how they're compensated and understand where those concerns might be. But there are different flavors to advice.
Right. Good stuff, Aaron.
Yeah, it's I guess I was a little surprised, like the conversation, like the value of a financial planner. That's an interesting path we went down.
Yeah, it's one of the things that kind of gets overlooked, because I think, when you're on the inside, how all of how that Venn diagram kind of fits together, but it's definitely not something that's kind of laid out. When you go search for a product or when you go seek advice, it's something that you kind of have to piece together over time, and sometimes get into the weeds to really figure out how it all connects together.
So kind of to wrap up, I think even though I consider myself a financial planner, because I charge for financial planning and I do financial planning work first, on my business card, I still put financial advisor. And I think that's in part because it's just a better, well-known phrase to the population as a whole, that they have a better idea of what to expect when they think of financial advisor.
Right. Yeah. I find myself using financial advisor a lot as well. And, we do begin the podcast with the notion that I'm a wealth advisor. And I think that's kind of stayed with me a little bit just because of my institutional experience from either the quantitative derivative space or the hedge fund space, where it's been more on that investment management side and more about the accumulation of wealth and the growth of wealth and whatnot. But the fact of the matter is it is very advice driven. And regardless of the fact that the industry is a little fuzzy on it, it just happens to be a good way to say, that's what we're here for. We're talking about advice.
Yeah, that's a great point. I didn't even think about it. We started off our conversation today with, I'm a financial advisor, with Trishul Patel, a wealth manager. Yeah, that's a great point to kind of. I didn't even need to point that out.
Right. Nice.
So yeah, that's good. This is a good conversation today. I think not as technical as last week, in part because there aren't really good studies. There's no I don't know if there's any technical studies on financial advice versus financial planning. I don't even know, how would you design a study like that?
It sounds like a good PhD topic.
Yeah, that's probably true. There probably is a PhD student at a financial planning program that's trying to distinguish financial planning from financial advice.
Yeah.
It might be a little easier to distinguish financial planning from investment advice. That might be possible.
Right. Well, maybe what we've said so far will help them along a bit.
We know a lot of financial planning PhD students are listening to our podcast.
Well, we found our niche.
There you go. Okay, this is a good conversation today, Trishul. Thank you.
Well, thanks, Aaron. I enjoyed it as well. And thanks, everybody, for listening. If you're enjoying these conversations, do spread the word. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and has no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.